Welcome back to our channel, where we explore the world of finance and investment. In today's episode, we're diving into the top 10 long-term investing strategies that can help you build wealth and secure your financial future. But before we begin, please like and subscribe to our YouTube channel for such amazing and informative videos. 1. Diversification. Diversification is a fundamental investment strategy that involves spreading your investments across various asset classes, industries, and geographic regions to reduce risk. The key idea behind diversification is not putting all your eggs in one basket. By holding a mix of different assets, you can potentially offset losses in one investment with gains in another, helping to create a more balanced and less volatile portfolio. Diversification can be achieved in several ways. Firstly, investors can diversify across asset classes, such as holding a combination of stocks, bonds, real estate, and cash equivalents. Secondly, within each asset class, further diversification can be achieved by investing in different industries or sectors. For example, within the stock market, you might hold shares in technology, healthcare, and energy companies to spread risk. Additionally, diversifying internationally by investing in foreign markets can also reduce risk associated with economic or political events in a single country. 2. Buy and hold. Buy and hold is an investment strategy based on the principle of acquiring assets and holding them for an extended period, often years or even decades, regardless of short-term market fluctuations. The core idea is that, over the long term, the value of quality investments tends to appreciate despite periodic market volatility. This strategy is often associated with stocks, but it can apply to other assets like real estate or bonds. The buy and hold strategy requires a patient and disciplined approach. Investors who adopt this strategy believe in the fundamental strength of the assets they hold and are willing to weather market ups and downs without frequent buying or selling. It's particularly suitable for long-term financial goals such as retirement planning, as it minimizes trading costs and capital gains taxes associated with frequent portfolio turnover. 3. Dividend investing. Dividend investing is an investment strategy focused on acquiring stocks or other income-generating assets from which investors receive regular dividend payments. Dividends are typically distributed by well-established, financially stable companies as a way to share their profits with shareholders. Investors who follow this strategy prioritize building a portfolio of dividend-paying stocks or assets to generate a steady stream of passive income. The appeal of dividend investing lies in its potential to provide a consistent cash flow while allowing investors to participate in the long-term growth of the companies they invest in. Dividend payments can serve as a source of income, which can be especially attractive for retirees or those seeking financial independence. Additionally, dividend-paying companies are often viewed as more stable and financially healthy, as they have a track record of sharing profits with shareholders. 4. Regular contributions. Regular contributions, also known as systematic investing or dollar-cost averaging, is an investment strategy where an individual consistently invests a fixed amount of money at regular intervals, regardless of market conditions. This approach helps investors avoid the stress and uncertainty of trying to time the market, and instead focuses on building wealth steadily over time. By making consistent contributions, investors benefit from the concept of averaging, which allows them to buy more shares when prices are low and fewer shares when prices are high. One of the key advantages of regular contributions is its discipline and automation. Investors set up a schedule, such as monthly or quarterly, to invest a predetermined amount, which can be directed into various asset classes like stocks, bonds, or mutual funds. 5. Research and due diligence. Research and due diligence are essential processes for anyone looking to make informed investment decisions. They involve gathering and analyzing information about potential investments to assess their viability and potential risks. These two practices help investors make well-thought-out choices that align with their financial goals and risk tolerance. In the context of investing, research entails examining various aspects of an investment opportunity, such as a stock, bond, mutual fund, or real estate property. This examination includes reviewing financial statements, historical performance data, and industry trends. Investors also need to consider macroeconomic factors, competitive landscape, and the management team behind the investment. Due diligence, on the other hand, goes beyond research and involves a thorough investigation of an investment's legal, financial, and operational aspects. This includes scrutinizing contracts, regulatory compliance, and potential legal liabilities. 6. Risk management. Risk management is a crucial aspect of investment and financial planning that involves identifying, assessing, and mitigating potential risks that could impact your financial well-being. Effective risk management is essential for preserving and growing your wealth while ensuring that you can weather unexpected challenges. It involves a strategic approach to minimizing the impact of adverse events and uncertainties. The first step in risk management is identifying the various types of risks you may face. These can include market risk, fluctuations in asset prices, credit risk, default by borrowers, inflation risk, purchasing power erosion, and more. Once risks are identified, the next step is assessing their potential impact and likelihood of occurrence. After assessing risks, risk mitigation strategies can be developed and implemented. 7. Long-term perspective. A long-term perspective is an investment approach that involves looking beyond short-term market fluctuations and focusing on achieving financial goals over an extended period, typically spanning several years or even decades. This strategy recognizes that markets can be volatile in the short term, and attempting to time these fluctuations can be challenging and risky. Instead, long-term investors adopt a patient outlook, emphasizing the importance of time and allowing investments to grow and compound. One of the key advantages of a long-term perspective is the ability to harness the power of compounding. By allowing investments to grow over time, the returns generated on initial capital can generate additional returns on those returns. This compounding effect can significantly increase the overall wealth accumulation. 8. Reinvestment. Reinvestment is a crucial strategy in the world of finance and investing, involving the redirection of earnings or returns generated from an investment back into the same or a similar investment. This approach aims to maximize the potential for wealth growth by leveraging the power of compounding. When returns, such as interest, dividends, or capital gains, are reinvested, they generate additional earnings that are in turn reinvested, creating a cycle of exponential growth over time. One common example of reinvestment is seen in dividend reinvestment plans, DRIPs, where investors use the dividends received from a stock to purchase additional shares of the same company's stock. This continuous reinvestment can significantly increase the number of shares held and consequently the potential for future dividend income. 9. Review and adjust. Review and adjust is a crucial step in any successful long-term investment strategy. It involves periodically evaluating your investment portfolio, financial goals, and the broader economic landscape to ensure that your investments are aligned with your objectives and are performing as expected. This process allows you to make necessary changes or adjustments to optimize your portfolio's performance and adapt to changing market conditions. During the review and adjust phase, investors typically assess the performance of their investments, considering factors such as returns, risk tolerance, and time horizon. They may rebalance their portfolio by buying or selling assets to maintain their desired asset allocation. Additionally, they might adjust their financial goals or investment strategy if their circumstances change, such as a new financial milestone or a shift in risk tolerance. 10. Seek professional advice. Seeking professional advice is a fundamental aspect of making informed financial decisions, especially when it comes to complex matters such as investing, tax planning, estate management, or retirement planning. Financial professionals such as certified financial planners, CFPs, investment advisors, tax consultants, and estate planning attorneys possess specialized knowledge and experience to help individuals and families navigate various financial complexities. One primary benefit of seeking professional advice is the personalized guidance it offers. These experts take into account your unique financial situation, goals, and risk tolerance to create a tailored financial plan that aligns with your objectives. They can provide insights into investment opportunities, tax-efficient strategies, and estate planning techniques that you may not be aware of. That's a wrap on our discussion of long-term investing strategies. If you found this information valuable, don't forget to like, subscribe, and hit that notification bell to stay updated with our latest insights. Thanks for tuning into our channel, your guide to financial success.